Thank you for joining me. I'm Alex, and I want to talk about the Monster Beverage Corporation. Way too long of a name to actually fit into the title. So, what they do is Monster Energy. I mean, that's, I guess, fairly obvious. They have other products, but like the great majority of their income is Monster Energy. Current price $83.26, which gives them a market cap of $43.9 billion, which is actually far bigger than I thought. Guess like the Red Bull niche is far bigger than I had imagined, but it's definitely the kind of crew I grew up with. So dividend is 0. I don't expect that to change anytime soon. The balance sheet is okay-ish, but they're definitely not in a position where paying a dividend would be better than just growing their business. So I don't really count on there being a dividend, and that's not factoring into my calculations at all. Revenue, $4.2 billion, earnings, $1.1 billion, both up significantly. PE 38 with a forward PE of 33, slightly high. I would expect more growth with a PE like that. I really don't think you would want to invest in a company with this PE and like 10-ish% revenue growth. I think a PE like that would be better served with earnings growth of like 25-ish% at the very least. So overall, I'm really not a fan of investing in companies with PE over 20, and I don't think that's very well justified here. Total assets, $5.2 billion. Total liabilities, just under $1 billion, which gives them a total stockholders' equity of $4.2 billion. And I'm not going to say this very much, but they kind of have too much money. So overall, you're looking at a balance sheet. You're looking for a balance sheet that has an assets to liabilities ratio of 2 to 3 to 1. Or, 2 to 1, 2, 3 to 1. I don't know how to accurately say that and describe what I mean, but anything over 3 to 1 is kind of too high, and they should be finding other things to do with their money rather than just leaving it laying around. So I don't like that they have too much money. I don't really like the PE being this high with the revenue growth that we have here. And obviously the lack of a dividend is kind of a problem for me, but it's a very minor problem. But as far as risk factors, there really are none. For some reason, Mountain Dew kind of got into the game of energy drinks, and for some reason, Coke kind of sort of got into the game, and nothing much happened. So I really don't think that there's any new players entering the market here, and I really don't think that there's any risk factors that are not priced in. With that said, I do like the company. I do think there's a future here, and I do think it's not a terrible investment. But overall, I just think that there's many other opportunities here that are better. So for a dividend investor, obviously there's nothing here. For a growth investor, a growth of 10% is kind of not enough. Like if you call yourself a growth investor, you kind of want companies that have far greater growth than 10%. So I don't think there's anything for you here either. For a value investor, the PE is too high. The balance sheet looks good. Basically just the PE being too high is kind of a problem. So for a value investor, a decent company here, but obviously there's better opportunities out there. So if you really can't figure out where to put your money, then I think this is a decent buy. But overall, I think that there's far better companies out there that will have a better balance sheet, a better PE, and a better revenue growth all at the same time. There's quite a few companies out there. So overall, I guess don't buy the stock. Anyone right now. If it got cheaper, I think this would be a clear buy, but right now As I said, unless you really don't know what to invest in, I don't think this is a good company to invest in right now. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.